What if I told you that your bank would fail, not because of a scam, because it didn't understand its own risks? One of the biggest banks in the world, Lehman Brothers, had collapsed in 2008, not just because of bad loans, but because of total failure in risk management. Behind every loan, every trade, and every digital transaction lies risk. And managing these risks is what keeps the banks and the economies alive. So in this video, let's decode 3 types of risks that banks face, and with that, understand how the global regulators had come together to create a common rulebook, which was the Basel Framework, and how the RBI adapted to it for India. Let's start with credit risk, which is the risk that the borrower won't pay back. For example, if a bank lends to a steel plant, there is always a chance, which happened a lot in 2010s when there was an increase in the NPA, that they won't pay back, and because of that, in the 2010s, thousands of crores were stuck and banks had to write off a lot of those amounts. That was credit risk in action. Next, let's talk about market risk. That comes from changes in interest rates, exchange rates, equity prices, and commodity prices. Say, a bank is holding a government bond and the interest rates increase. That will lead to the bond prices falling, which will have a negative impact on the bank's entire portfolio value. Or let's say if the exchange rates are not in favor and the rupee depreciates. So in that case, a company or a bank with a lot of foreign borrowing, with a lot of repayment obligations in foreign currencies, would see their repayment burden increase by a factor. So even without defaults, the banks can stand to lose billions on account of market risk. And finally, operational risk. These are the risks that are caused by failures in systems, people, or processes. So let's say a cyber attack on mobile banking, or an ATM outage, or even internal fraud. They are all examples of operational risk. So if there was a cyber attack and the system halts, the customers would panic, the trust would erode, and because of that, the regulators would step in. So operational risk is not just technical, it's reputational. Now the big question, how do central banks and other banks ensure that these risks are managed across the world in a consistent way? That's where the Basel Framework steps in. The Basel Framework is a set of regulations and standards that was built by the Basel Committee on Banking Supervision, which is formed by the central banks of major economies. The first version came out in 1988. It mainly targeted credit risk by introducing a minimum capital rule. The banks had to hold at least 8% of their risk-weighted assets as capital. Then, in 2004, came Basel II, adding sophistication. It introduced the 3-pillar framework. Pillar 1, the minimum capital requirements. Pillar 2 was the supervisory review. And Pillar 3, the market discipline. So the second version, which was Basel II, included market risk and operational risks as well. But the real game changer was Basel III, which came out after the global financial crisis, which had exposed the brutal truth. The banks had capital, but they did not have the right quality of capital. They lacked liquidity, which is the ability to survive short-term shocks. Basel III introduced more stringent capital definitions, introduced new buffers like the capital conservation buffer, and introduced liquidity ratios such as the LCR and the NSFR. Global regulations are great, but every country needs to turn them into local realities basis their own unique risks. In India, that's where RBI comes in. It adopted the Basel norms, but it added its own customizations. In India, banks must follow ICAP, which is the internal capital adequacy assessment process to assess their unique risks. Stress testing is mandatory. Banks must simulate shocks like rate hikes and currency pairs devaluation. And the capital conservation buffer that is mandated by RBI is slightly higher than what is mandated by Basel because of the higher volatility environment, which is India. So let's also remember that in the wake of INFS default in 2018, the RBI had made the regulations on NBFC a lot more stringent. So while the global standards do provide the framework, RBI and other central banks and regulatory authorities provide or add their own guardrails to customize the risk framework according to each country's unique landscape. This allows the adaptation of global standards so that they're consistent, but also so that the standards are locally resilient.